What we've guided to is 30 to 40% of our cash flow from operations coming back to shareholders, so shareholder distributions. What we saw in 2023 is we were slightly above the higher end of that range at 42%. As we continue to deliver the strategy, the whole point and the whole focus of the strategy is creating more free cash flow per share. So we will continue to stay within the 30 to 40% or thereabouts through the cycle, but continue to create the capacity to be able to reward our shareholders as we have done in 2023 and as we hope to continue to do in 2024.
Okay, so you have the cash flow, you have the balance sheet. Many would look at that and say, you are ready, you are primed for more M&A activity. Do you expect to be more active this year when it comes to mergers and acquisitions?
Our focus is very much on delivering the first sprint that we announced. We are essentially just over 2 quarters into what is a 10-quarter sprint. And what we have identified is that actually the largest value opportunity for us is in just unlocking the full potential of this company. And so while we will continue to look at bolt-ons to our current portfolio, we expect to stay within the $22 to $25 billion capex range that we have guided to. And we will continue to look at preferentially going after buybacks. Because if I'm honest with you, Tom, the most attractive opportunity to allocate capital to in the sector, I think right now, is to buy back our shares at north of 15% free cash flow yield. And that is with a company that is actually building the momentum that we have. It's not a bad buy for us, and that's why we're focused on ourselves from now.
Okay, let me get your view on the oil price. We've seen gains in oil of about 7% through the month of January. There is this tension, it seems, between the demand question, whether that's softening, and the geopolitics. How do you see that evolving in the months and quarters ahead?
What we see at the moment is the market is well supplied. The demand has been remarkably resilient in 2023, despite multiple headwinds. The supply side is the bigger question at the moment. Questions around OPEC cohesion, questions around how sanctions might play up. You'll have picked up, of course, potential increase of sanctions against Venezuela and Iran, potential enforcement or tightening the enforcement of sanctions against Russia. All of that, I think, is raising questions around the supply side, not to mention the slight slowdown in the growth of the shales patch. All of that, I think, is just creating a bit more of tightening in the overall market, and we'll see how that plays out. But a lot of it will be based on geopolitics more so than anything else at the moment.
The gas trading desk, once again, knocking it out of the park, doing very well, putting a very good performance in. Is there anything that derails the strength that's coming through from the gas trading team?
I think the Q4 was indeed an exceptional quarter for our trading and optimization organization. We saw the opening of East-West arbs through the quarter, and we had length, as we typically do in the Northern Hemisphere winters. And that allowed us to take those opportunities and create real value. What you have seen so far this year, at the start of 2024, is the arbs aren't as wide as they were, so less running room there, and prices have come down. I think with fundamentals being reasserted now, as you see a better storage balance in places like Europe and Asia, and a milder winter.
How do you see the LNG outlook or demand outlook kind of evolving and changing as well, given that economies' growth is slowing, rates remain relatively high, the inventories are well filled here in Europe? What does the picture look like in terms of that demand for LNG?
So far, we're in balance from what we see, but the biggest determinant of demand growth, I think, will come from China and how China responds through 2024. Early signs are positive. While China hasn't essentially fulfilled what some people had expected coming out of COVID, they continue to grow, and we see the LNG import growth continue, in particular at these lower prices now that they are able to buy at these levels. And so that's going to be a big determinant. What's I think key in 2024 is there isn't a lot of new supply coming into the market. And so as you go back into stock refilling after the winter, I suspect you'll see robust demand. So for the coming year and a half, I think there'll be some good demand. I think one thing to keep in mind in the medium term is China, again, will draw a lot of gas. To give you a sense of that, just in 2024 and 2025, the volume of natural gas power generation capacity that China is building is equivalent to the entire installed capacity in the UK today. And that's just China's build out. So there will be a lot of demand for LNG.
What is your reaction to this decision by the Biden administration to pause the build out, the licenses, the approvals for export facilities, LNG export facilities in the US? What's your reaction to that? Does it put any of your investment plans in the US at risk?
I think the short, medium term, there will be very little impact to the LNG markets. What it does is it undermines confidence, I think, in the longer term when it comes to US LNG, which is a real shame given the world demand for LNG is going to continue to grow, and the US is the largest supplier of LNG today. So a pause like this can always create more uncertainty, in particular when you're looking at long-term investments. That and, for example, the behavior of Venture Global in the US to not honor the contracts towards its off-takers, all of that just undermines confidence in US LNG at a time when the world, including here in Europe, really need the stability of LNG supplies.